I want to tell you about the mistakes I made when I used my VA loan for the first time. I was a Marine Corps infantry officer, college degree. I thought I had this figured out. I thought it was straightforward, something that you couldn't mess up. I was wrong. If you're stationed at Fort Sill, or you're an artilleryman who came through here, Army or Marine, you already know Fort Sill is the crossroads for field artillery. A lot of you train here. A lot of you are thinking about putting down roots right here in Lawton. I'm going to unpack exactly how all these mistakes could have been prevented so that if you make some of the same choices I did, you go in eyes wide open. Because if you decide to buy a townhouse or stretch your budget further than you should, you need very specific goals, plans, and intentions going in. That's what this video is going to give you. By the end of this, you're going to know the 3 numbers every VA buyer needs before they talk to a single real estate agent. You're going to know the questions your loan officer should be asking you before you ever start shopping. And I'm going to walk you through a real property comparison right here in Lawton to show you how the math actually works on a deal. Let's get into it. Before anything else, I need to make sure you understand what's actually inside a mortgage payment. Because when I used my VA loan for the first time, I didn't fully understand this, and it changed what my monthly payment actually felt like to live with. A mortgage payment has up to 5 parts. Principal and interest, that's the part that pays down your loan and covers the cost of borrowing. Property taxes, collected monthly and held in escrow. When I used my first VA loan, I didn't even realize taxes were included in the mortgage. They are. Homeowner's insurance, also collected monthly and held in escrow. And HOA fees, if applicable. This one gets people. If you buy into a townhouse or a condo community without understanding HOA fees, you can get hit with $150 to $700 a month in fees that do absolutely nothing to pay down your principal. Not $1 goes toward your loan. It's just the cost of being in that community. I want you to know all 5 of these before you ever agree to a payment number with your loan officer. Now let me walk you through the 3 mistakes I made so you don't. Mistake 1, I was focused on the interest rate instead of the monthly payment and what that monthly payment was going to allow me to do or not do with the rest of my financial life. The rate is one variable. The payment is what you actually live with every month. I should have started with what I could afford to pay and still give, save, go on dates, and live the life I wanted. I didn't. I started with the rate and worked backwards, and that approach costed me. Mistake 2. I bought a townhouse without thinking carefully about my timeline or having a real plan for that property. I've owned my townhouse for about 4 years now. I have renters in it and I'm breaking even on cash flow. I want to be clear, it's still an asset, someone is mostly paying for it, I get a write-off depreciation and interest on my taxes and it will eventually appreciate. But I want you to be prepared. You're probably not going to make any money off a townhouse for a while. If you plan to rent it out at some point, go in knowing you might just break even or occasionally put a little money in to have somebody live there. It's not a disaster, but it's not what I expected going in. Mistake 3, I didn't think hard enough about how that monthly payment was going to affect my long-term goals of giving, saving, going on vacation, and living the life I wanted. The payment felt fine on day 1, but between the HOA, the maintenance costs, and everything else that shows up after closing, it changed the picture. Make sure you run those real numbers before you commit. Real quick, if you're a veteran and you feel like somebody talked over your head, didn't really explain your VA loan clearly, or made you feel like you weren't going to be able to use the benefit you earned, you might just need a better game plan. If you want help building an action plan or just want to understand how to better use your VA loan benefit, reach out to me directly. Jump in the comment section, you'll see my email, my phone number, and my website. We'll get on a call, figure out your specific situation, and get you moving forward towards closing. If this video is helping you, subscribe. We put out VA loan education every single week designed to help veterans build wealth through real estate. Now let's keep going. Now let's get into the discovery questions, the ones I wish my lender had asked me. Here's the honest truth. If my lender had gone through these discovery questions with me before I bought my first home and told me how cash, credit, and income were going to affect my life after closing, I never would have made those 3 mistakes. So let me ask you the questions I wish somebody would have asked me. Where do you want to live? And what does your commute look like? This one matters more than most people realize, especially if you're active duty. Anytime I hear that a service member is commuting more than 45 minutes, I have a very direct conversation with them. One of the leading causes of fatalities among active duty service members is driving while fatigued. A 45-minute commute each way isn't just inconvenient, it's dangerous. And for a veteran, that same commute takes time from your family and your quality of life every single day. Lawton has the advantage here. Most of the city is a short drive to Fort Sill. think hard about this before you pick a location. How long are you going to stay? This is a question I didn't answer honestly with myself, and it cost me. If you think you're moving in less than 3 years, this is probably not your time to buy. You can rent your house after living in it for as little as 1 year on a VA loan, but talk to your loan officer and go in knowing that if you put nothing down, you may be breaking even or paying money out of pocket to have renters in it. If you're okay with all of that and your income supports it, fine, but know that reality before you close. Between 3 and 5 years, you're in a gray zone, 5 or more, and you're in a position to actually build equity. What property type are you actually looking for? Single family home, townhouse, or condo? Single family homes appreciate faster, give you more control, and don't come with HOA fees that eat up your cash flow. That's my default recommendation for most VA buyers. Townhouses can make sense on price, but if you're not staying 5 to 7 years minimum, go in eyes wide open. You may not come out ahead on a sale. And if you end up renting it, you may just break even like I did. Condos, make sure it's on the VA approved condo list before you fall in love with it. Not all condos qualify for VA financing. What are your goals after closing? What do you want your financial life to look like after you close? Can you still give? Can you still save? Can you still go on vacation and live the life you actually want? If the payment on a house you're considering is going to make all those things harder, that's important information. Get it before you buy, not after. One more quick note, having this conversation with your loan officer is important, but you also need a realtor who's on the same page. If you don't have a real estate agent yet, or the one you have isn't the right one, I'm connected with great agents all over the country and I'd love to help. My contact info, as always, is in the comments. Now let's talk about the 3 pillars every lender is looking at: cash, credit, and income. Every lender is evaluating all 3 when they look at your file. Here's what each one actually means for a VA buyer. Cash. No down payment required on a VA loan, but I want reserves after closing. At least 2 to 3 months of your mortgage payment in the bank. If something breaks in month 2 and you have nothing left, you're back on credit cards. That's a position I never want a borrower to be in if we can avoid it. Credit. Here's something most people don't know. There is no minimum credit score requirement to use your VA loan. I've had borrowers with scores in the 400s get approved and close on houses. That's a longer conversation worth its own video. What VA underwriters care most about is your last 12 months of payment history. Have you been paying your bills on time for the past year? That tells the underwriter more about who you are right now than your score does. Some lenders add their own credit score minimums on top of VA guidelines. Those are called overlays. If you've been told no because of your score, it may be that lender's overlay, not a VA requirement. Know the difference. Income. My benchmark I want is your total housing payment at 25% or less of your gross monthly income. That's principal, interest, taxes, insurance, and HOA all included. All at or under 25%, and you have breathing room to live the life you want after you close. The VA doesn't technically use a front-end debt-to-income ratio the way conventional lenders do. What they actually measure is residual income, how much you have left over in a dollar figure after all your housing, your debts are paid. But that 25% front-end is a practical check you can run yourself before we ever get into the technical details. Once we've gone through these questions and the 3 pillars, here's what you should walk away knowing before you make an offer. You should be able to establish 3 things: your target monthly payment, the number you can live with and still build the life you want, your cash to close. Yes, it's a 0 down loan, but closing costs still exist. We're going to talk about how to get a motivated seller to cover those closing costs, but you should still know the number. Your target purchase price. Get a real pre-approval up to your ceiling. Your documents go to an actual underwriter before you ever make an offer. When you write that contract, you're still standing on solid ground. No last minute conditions, no risk of losing your earnest money. Get the pre-approval up to your max comfortable price point so you're not going back to your loan officer every time you want to make an offer on a different property. Let's talk about your real estate agent and how their commission works now. Post the NAR settlement, buyer agent compensation is negotiable. In the right scenario with the right motivated seller, you may be able to get the seller to cover your agent's commission as part of the deal on top of your closing costs. Here's what I look for in a real estate agent for a VA buyer. Do they understand VA loans? Not just I've worked with VA buyers before, but do they actually understand the appraisal process and why a VA loan is not a liability on a deal? Are they willing to negotiate seller paid closing costs aggressively? This is a skill. Not every agent knows how to structure an offer that gets you what you need without killing the deal. Do they communicate quickly in a competitive market as slow agent costs you deals? And will they tell you the truth about a property, including the things you don't want to hear? If you don't have a real estate agent, I'm connected with great VA agents all across the country. Again, my contact info in the comments. Now I'm going to walk you through 2 real properties right here in Lawton. The principles apply wherever you're buying. I'm using this market so the numbers are grounded in something real. So let's talk about our borrower pair. The first borrower, active duty, E5, over 4 years of service, basic pay about $4,000 a month, BAH a little under $1,500 with $500 BAS, no dependents, total pay just shy of $6,000. Here's something most loan officers don't maximize for you. BAH and BAS are tax-free income. VA guidelines allow us to gross those numbers up 25% instead of only giving you credit for those dollars at face value. We give you credit for that tax-free income grossed up to 25%. So that brings us to about $2,000 and $2,450 in total qualifying tax-free income. This is a tool, not always something we need to use, but if you need to reduce your DTI to qualify for more house, this is how we do it. Monthly liabilities in this case, a vehicle about $325, a small loan of $150, total about $450 of debt. Real low DTI on the front end. Second borrower. This is not the veteran, this is the veteran's spouse. W-2, $80,000 a year, works a standard 9 to 5, gets taxed, qualifying income just shy of $7,000 a month. These two are buying together. Combined qualifying income, $6,387 plus $6,667 equals about $13,000 a month. The vehicle, $226 a month. 12 payments remaining, we count it 12 months is outside of the window where we could potentially exclude it from the DTI. We got a medical collection in here, $1,300 balance. The VA does not require this to be paid off. We count 5% of the outstanding balance, which factors into our DTI. Combined monthly liabilities, $476 plus $226 plus $65 equals $767 a month. That combined DTI before the housing expense is 5.9%. Very strong profile. So here's the first property we're looking at. Single family in Lawton, 4-bed, 2-bath, 1,600 square feet, built in 2016, tiny HOA, $17 a month for neighborhood pool and clubhouse. Cache school district, which carries some of the better school ratings in the area, about 15 to 20 miles to Fort Sill. List price, $245,000. On the market, 46 days. It actually went under contract and then came back on the market a few weeks ago. That's a motivated seller. So here's what I do. This home has been sitting for 46 days and it already fell out of contract once. That tells me the seller wants to move it. We're going to offer right around $245,000 and ask for roughly 4%, about $9,800 in seller paid closing costs. And because it fell out of contract, we may even have room to push the price down a little bit. Here's what most veterans don't know per the VA pamphlet 26-7, Chapter 8, page 11. There is no maximum on seller paid closing costs on a VA loan. The seller can cover every dollar of your closing costs if they're willing. That is not true on conventional loans. A motivated seller on a house that's been sitting and already lost one buyer is exactly when you want to use this. One more thing worth noting, even with a VA funding fee financed into your loan, the VA loan is still the best loan program available to you. Your monthly payment is going to be lower than any FHA or conventional alternative. And if you're a veteran with a 10% or greater VA disability rating, you don't pay a funding fee at all. At $245,000, funding fee financing, the loan amount is approximately $250, $300. Principal and interest, $1,460 to $1,580 range at current market rates. Property taxes, approximately $235 a month. Homeowners insurance, approximately $110 to $130. HOA, about $17. Total payment approximately $1,830 to $1,950. Combined DTI about $1,900 house plus $767 in liabilities equals $2,667. Divided by $13,054, that DTI comes in around 20%. Very clean. Second property, a townhouse, also in Lawton, in a gated golf course community with a pool, 3-bed, 2-bath, 2,100 square feet, built in 1984. List price $214. It's been on the market for 95 days. Now, one honest note, this is an interior unit. It has a neighbor on both sides, so you're sharing 2 walls. That's the opposite of what you want in a townhouse. An end unit gives you more privacy, more light, and better resale. This one doesn't have that. And the HOA here is about $157 a month. That's $157 every month. That does nothing to pay down your loan. I already told you what I think about townhouses, and I'm speaking from experience. If you're not planning to stay 5 to 7 years, go in eyes wide open. you may end up renting it out and just breaking even on cash flow, like I am. It's still an asset. Someone is mostly paying for it. You get to write off depreciation and interest, but be prepared that you probably are not going to make money off this for a while. Let's talk about our payment estimate on this townhouse. At $214,000, zero down. The loan amount after funding fees approximately $218,600. Principal and interest, $1,275 to the $1,380 range at the current market rates. Property taxes, about $139. Homeowners insurance, about $95. HOA, $157. Total payment, approximately $1,665 to $1,770 a month. Combined DTI, about $1,720 plus $767 equals $2,487 divided by $13,054. DTI less about 19%. Here's the thing, both of the houses fall well under that 25% housing to income ratio. Both are within budget. Both leave this couple plenty of room to give, save, and go on vacation. These are both great payments. And notice the townhouse payment is actually a little lower because it's cheaper. So if both work financially, which one would I choose? I'm gonna go with the one that appreciates more. The single family home is newer, it has no shared walls, and its HOA is only $17 a month instead of that $157 that you're never gonna get back. It's gonna be more desirable to rent out down the road. It's gonna cash flow sooner if they do rent it, and it's going to appreciate faster than an older interior townhouse. Better long-term position, basically the same affordable payment. That's the one I'd push this couple toward, assuming their timeline supports staying long enough to make the most of it. Let's recap what we covered. A mortgage payment has up to 5 parts: principal, interest, taxes, insurance, and HOA. Know all 5 before you agree to a number. 3 mistakes I made: focusing on the rate instead of the payment. I bought a townhouse without a real plan for my timeline and didn't anchor my purchase to my long-term financial goals. If my lender had asked me the discovery questions I just walked you through, the commute, the timeline, the property type, the post-closing financial goals, I never would have made those mistakes. Make sure your loan officer is having this conversation with you, and make sure your real estate agent is on the same page. Cash, credit, income. No minimum credit score on a VA loan. Underwriters care most about the last 12 months of payment history. Keep your housing at 25% or less of your gross monthly income. Gross up your BAH and BAS. Medical collections don't require payoff. Count 5% of the balance in your DTI. No maximum on seller paid closing costs. Offer around $245,000. Ask for roughly 4% in credits. And use a motivated, fell out of contract listing to your advantage. The VA loan is still the best loan program, even with a funding fee. And if you have a 10% or greater disability rating, you don't pay one at all. When the payments are close and both fall within budget, go with a property that appreciates more and positions you better long term. Here in Lawton, that's a single family home.